Welcome back to the Junius Maltby channel. Got some great stories and news to discuss today. Well, I don't know if it's great, but it's news anyways. And the first story is one of the benefits of having this channel is the many of you out there, the 12,000 different subscribers, some of you are pretty active in hunting down and finding good stories yourselves. And that's where this one comes from. I just didn't have time to really get a lot of stories researched today and really get into them. I was out doing some errands and other tasks. Well, one of you emailed me this article here, and it's a good one, so we're going to cover it first. It's from the Daily Economist, Financial News and Economic Items of Interest. Here's the headline: Shanghai Gold Exchange on brink of taking over control of gold prices following VIP meeting and actions after Fed rate hike. If you're wondering what the Shanghai Gold Exchange is, we covered it in 3 or 4 videos when it really broke, when the news really came out here in the West regarding the Shanghai Gold Exchange, the influence it might have on the world gold market scene. The article contains an interesting graphic, which I did a double take at, and if you zoom in here and look at the actual $20 bill behind the Kung Fu Panda there, you can see all the little details that are written on this bill. Very interesting if you get a chance to pause it and just kind of take that bill apart. A lot of hidden little things there in that bill. Getting into the article, in a rushed update put out on March 17th by economic analyst Dr. Jim Willey, it appears that following the Federal Reserve's raising of interest rates 2 days ago, China, through the Shanghai Gold Exchange, may finally be moving up its plans to wrest control over the gold price from markets in the West. In a new article published in tandem with his normal monthly hat trick letter, Dr. Willey reported that it appears that the Chinese are now accelerating their plans to disconnect from dollar hegemony following the Fed's recent FOMC meeting and rate hike, and in response to the market reactions made in the dollar and bond rates following the central bank's March monetary policy move. Something big is afoot in the Shanghai gold market. It seems that we are at the door of the reset finally, with China being betrayed by the U.S. government and U.S. Fed in concerted collusion. The attempt to reduce the U.S. dollar while maintaining ultra-low bond yields seems the final straw. The inference is made that the jig is up finally, and a significant turning point is upon us. A contact at Evolution Consulting has reported that his best contact notified him that VIPs are being invited to take tours of the Shanghai Gold Exchange operation. This man was among one of the guests. These tours are not being arranged in some congenial welcoming event, not at all. Rather, they are informational and official in granted preview. They are almost surely being staged to inform the opposition that it is all over for them now. With a cherry on top, the VIP guests were required to pay for the tour. The above juicy tidbit was provided by a client passing the word along. Something big is afoot. China seems to have changed its position toward aggressive in the gold market introduction with gusto and emphasis. Conclude easily that where there is smoke, there is fire, and the heat will be on physical gold metal demand in Asia. In turn, the pressure will be put on the U.S. dollar, whose custodians are not honorable, and for perhaps the last time have betrayed the Chinese. Lower U.S. dollar valuation combined with already chronic low bond yield could have turned the Chinese hostile in the wake of the U.S. Fed rate hike. Analyst London Paul believes something significant is on the verge of breaking the paper gold market. The clues have come on the behavior of the gold market since the Yellen Fed announced its small rate hike. It was small but significant and probably involved a lie to the Chinese government finance ministers. Such coincidences do happen, but odds are against a coincidence in this case, since so critically important. Time will bear out the conclusion. The Western bankers have a long history of lies, deceit, betrayal, subterfuge, sabotage, and pilferage. They might have sacked their economies on the road to the global fascist state, but China has not signed up for the destructive evil development and pathway. Euro Raj also confirmed London Paul's suspicion and tentative conclusion. He mentioned that such view is absolutely right, given the market reaction. Someone at the Shanghai Gold Exchange spiked the price higher the moment the Fed raised rates, which required the paper market to follow higher. He stated unequivocally that the Chinese do not consider the U.S. Fed, the banker cabal, and the U.S. elite as honest business partners any longer. He expects their harsh, clear revenge to follow, with the launch of the long-awaited global currency reset to come next. U.S. President Trump visiting the Andrew Jackson grave site was another sign, as Jackson was an arch enemy of the banker cabal. He survived an assassination attempt. Neither Trump nor China wanted the rate hike. Trump does not want higher U.S. government borrowing costs or the added economic headwind. China does not want lower bond principal value and lower U.S. dollar value. Hence, the East appears to have burned the Western banker cabal with a paper fire that could turn into a bonfire in gold medal demand. China likely perceived a maneuver to sabotage Trump by the banker cabal, and the Beijing leaders yelled punt, game over, no more cooperation. At least in the Eastern Hemisphere, the U.S. dollar is about to be kicked to the curb, shunned in trade payment usage. The non-U.S. dollar platforms will be given much greater emphasis. The game is about to change to enter the extreme danger zone. Yet even this new information doesn't take into account the sudden exit from the London silver fix last week by the CME Group and Thomson Reuters, who may have also seen the writing on the wall that the West is losing control over the manipulation of gold and silver prices, as well as bond yields for the U.S. Treasuries. It was said by many that March 15th would be a critical date for the economic, financial, political, and geopolitical spectrums, and that the Ides of March may show itself in mysterious and unpredicted ways. And going forward with the Fed raising interest rates at a time when economic data is screaming that the U.S., if not the rest of the world, is bordering on recession, the reality that the time of protectionism and all countries looking out for themselves may very well be upon the global financial landscape. So that's definitely an interesting perspective and news that we don't see or hear about much elsewhere. The next series of articles discusses the health of the U.S. dollar. There's several headlines and articles out there today within the last 24 hours covering the U.S. dollar, saying things like U.S. dollar looks to Fed commentary for a lifeline. The U.S. dollar was down as the FOMC impact continues to reverberate. Nearing RBNZ rate decision offers a boost to the New Zealand dollar. The G20 outcome may stoke risk aversion, Fed's Evans to speak. The U.S. dollar traded lower against its leading counterparts as front-end Treasury bond yields declined, undermining rates-based support for the benchmark currency. The move may amount to follow-on momentum from last week's FOMC rate decision. The greenback slumped after Chair Yellen and company issued a broadly expected rate hike, but offered nothing to suggest a steeper tightening path thereafter. The U.S. dollar really is overvalued, from Paul Hallwood, University of Connecticut, U.S. U.S. dollar outlook headed to below 100 before rebounding, from Westpac. U.S. dollar factors 1 week after a strong run during February and early March. The U.S. dollar has flipped into negative mode, the main catalyst being the FOMC meeting last week, which stressed gradualism in its tightening cycle. The U.S. dollar index could easily fall to the multi-month range low of 99. This week's event calendar is thin. New and existing home sales and durable goods orders, Fed speak, will be more important and plentiful, including Evans, George, Mester, Kashkari, Kaplan, Bullard, and Yellen. Gold prices have hit a 2-week high as the U.S. dollar continues to edge lower. Gold has built on gains made last week as the U.S. dollar slides to 6-week lows. The yellow metal edged up $5.30 to $12.3550 per ounce, hitting a 2-week high after making substantial gains following the Federal Reserve's decision to hike interest rates last week. Dollar bulls checked by U.S. rate policy and trade concerns. Emerging market currencies big winners after last week's Federal Reserve meeting. The U.S. dollar is being hit by investor reaction to the Federal Reserve's measured policy tone and concerns over the Trump administration's protectionist trajectory and the legislative obstacles it faces. We are closer to a currency war than we have been for a long time, said Ulrich Luchtmann of Commerzbank. Stephen Englander, Citigroup's head of forex strategy, warned that the dollar would head lower if the House vote on repealing Obamacare on Thursday was defeated, since it augured ill for the administration's tax reform agenda. Quote, bottom line, if it goes down in smoke, it will probably take the U.S. dollar down with it. As the odds of any significant legislative action fall, U.S. dollar could hit the lows of the year against both majors and minors, Mr. Englander said. The dollar's direction is likely to come under increasing influence from non-U.S. factors, said J.P. Morgan, including Eurozone data and European political risk. This further enhances the sense that the U.S. is losing its centrality in driving currency markets, after having dominated the foreign currency narrative for many months post-election, said J.P. Morgan analysts. So in summary there, we see a potential for China to get more involved and more aggressive with their gold price policy. We see the potential for a dollar weakening, the potential for currency wars. We've even seen mention of trade wars. And as many discuss, currency wars and trade wars often lead to shooting wars. When you take all this information just from these few stories here and just news that broke within the last 24 to 48 hours, and you combine it with the stories we looked at yesterday, the main story yesterday about the U.S. debt and the derivatives markets, it really does paint a picture for stacking precious metals. I don't see how one could question having a pile of gold and silver would be a bad thing going into the economic storm that we see brewing on the horizon. Thanks for tuning in and being part of the Junius Maltby channel. Hope you found this clip enjoyable. If so, smash the like button and explore the archives for other videos that might suit your interests. Keep stacking and have a good day.